Hi, this is Nilus Mattive for Money and Markets TV. A couple weeks ago, I told you about covered call writing, my favorite option strategy for generating income. In that video, I also mentioned that I absolutely positively do not recommend writing naked calls. Let me remind you of the difference. With a covered call, you own the underlying shares that you're writing against, but a naked call is written without owning the underlying stock. To understand why writing naked calls is so dangerous, let's consider a simple example. Say that shares of XYZ Corporation are trading at $28, and you decide to write a call option on it, which expires 2 months out and has a strike price of $35. You sell the contract for $200. Here's the important part. You don't own 100 shares of XYZ, and you decide not to purchase them. Then, a few weeks later, XYZ announces that it's being acquired by a rival for $60 a share. Now, if you had opted to write a covered call and actually bought the stock at $28, this wouldn't be a big deal. Sure, you'd be kicking yourself that you missed out on all that upside, but that's the worst thing that would have happened. Instead, you're going to lose at least $5,800 on your naked call. That's because you are now responsible for delivering 100 shares of XYZ when the contract is exercised. That means you have to go out on the open market and buy them at $60 a share. That's $6,000 minus the $200 in premium you collected. So you can see why writing naked calls is so dangerous. Your profit is completely capped at the premium you collect, while your losses can grow without limit. Don't get me wrong, some people do use this strategy to make money, but they are very adept at writing contracts that will likely expire quickly and without being exercised. Most investors will be better off avoiding naked call writing altogether. However, there is one naked option strategy that I do consider safe and effective for income generation. It's called naked put writing, and it's like the mirror image of covered call writing. You're basically telling someone that you'd be willing to buy their shares if they fall to a certain level. However, you must be ready to take ownership of the underlying stock too. Like all options contracts, a naked put covers a round lot of stock, or 100 shares. So let's say you want to buy 100 shares of XYZ stock, but you think it's overpriced at today's levels. Well, instead of placing a limit order with your broker, or watching the ticker tape relentlessly for weeks on end, you could write a naked put near your buy price instead. Then, if the stock falls to that level, or below it, odds are very good that the contract holder will put his shares to you. And since you also get to keep the options premium, you've actually gotten them a little cheaper than the strike price of the contract. Even if the stock doesn't reach your strike price during the life of the contract, you keep the premium and you're free to write another put. Keep pursuing this same strategy and you could really make a lot of money for just waiting around. However, there are a couple of things you should know. First, you could start off with an immediate paper loss when you take possession of your shares if they've fallen below the strike price. Second, those losses could be substantial if the stock implodes. And third, you must have enough cash in your brokerage account to cover the potential stock purchase under the put contract. For these reasons, I consider naked put writing riskier and more aggressive than writing covered calls. But if you're looking for a way to target specific stocks upon further downside, this approach proves that it isn't always a bad idea to go naked. For Money and Markets TV, I'm Nilus Mattive. Thanks for watching.